How's it going, everybody? My name's Antonio, and I am here today to put Energy CEO John Cash on the barbecue and see how well he cooks. Energy is a low-cost ISR uranium producer, so they're actually producing. They're not looking for uranium. They know it's there, and they're actually making money on it as we speak. They're based in the U.S., Wyoming, to be specific. They're trading therefore in the U.S. on a New York Stock Exchange ARCA under URG, but also in Toronto under UER. As I was saying, they already have sales contracts in place. Those contracts go through 2028 for a portion of their uranium, so not all of it. It's roughly 600,000 pounds per year, to be specific. And they were also awarded a government contract to sell 100,000 pounds into the strategic reserve at roughly $64.50 per pound. Well, that was actually their decision as to why they exactly sold 100,000, but John can say more about that later. But so they had some in inventory. They didn't want to sell the whole inventory. They now have roughly 200,000 pounds in inventory, which is ready to service contracts starting this year. So yeah, this year, 2023, the company is expected to sell a total of 280,000 pounds of yellow cake. So that's E3O8, drums of yellow cake, basically, at an average price of $68.89, so roughly $62 a pound, for a total revenue of $17.3 million this year. URG also has all the permits ready to ramp up production. They've got roughly 50 people working at site at Lost Creek. Some of them are being trained, ready to ramp up that production, but there are a few more permits needed, I guess, to expand beyond what is already being licensed right now. Licensed at 2.2 million pounds per year, although production is not there yet, but we're going to talk about that as well. They have another property. It's called Shirley Basin. This one is expected to produce uranium at even lower cost than Lost Creek because mineralization there is closer to surface and infrastructure is better. A couple of stuff like that. Also something that we're going to be talking about. They've now gotten all the permits to start building there, although they're not yet doing that. They're not yet taking that decision to start producing, as you're going to see, the conservative nature of this company says that they first want to have some supply contracts in place before they can put the money there to work. So Shirley Basin is a 1 million pounds per year well field and 2 million pounds per year processing plant operation. So again, hopefully you're going to hear more about that in this conversation. It's also worth noting that the company has entered into an agreement with a smaller company, a uranium exploration company that has projects sort of east of the Lost Creek operation, which in combination with their cash position, which in March was roughly $80 million, a little bit less now, but still in that wheelhouse. I am hoping, and I'm speculating here, that might mean a little bit of M&A in the not too distant future. All right, John, I'm going to shut up now. What am I missing here in the description?
Yeah, a lot of people don't realize we've been in production for a very long time at Energy. At Lost Creek, we've been in production for over 9 years. We did allow that production to decline for a few years because the market didn't, support full production. But we've produced nearly 3 million pounds from Lost Creek. So from a technical perspective, it's largely been de-risked. We've had a lot of pounds come out of the mine with fantastic recovery rates. Our average recovery rate over 9 years is 90%, which is really setting the standard very high for the rest of the industry to follow. And we're a very low-cost producer. In 2015, our cash cost was a little over $16 a pound. That's C1 cash cost. The all-in mine site that year was a little over $33 a pound. And if you throw in corporate overhead and everything, that puts us into the 40s. So inflation is not going to allow us to get back to those numbers, but we believe we can get very close. So we are a proven entity, and there are very, very few proven entities, low-cost producers out there. So we are in a very, very small club. And those contracts you talked about, they're allowing us to get back into commercial production with some very good returns, some very good revenues for the coming years. So yeah, it's a very exciting time to be in the industry, and we've got the assets and the people to be able to perform.
So you basically go to bed every night and you just sleep as a baby. That's what you're saying.
I sleep like a baby. There will always be challenges. Mining is not easy. If it was, everybody would do it. So there are always challenges, but by and large, yeah, I sleep really well.
We're going to be talking about those challenges and what you're doing to solve some of those. I am glad that you mentioned that $40 all in cost, because some producers going to mention the cash cost, others are going to mention the all in sustaining cost, or both, but they're kind of confusing. G&A is not in there. Financial costs and stuff like that, not always in there. So it's confusing, but you're saying at $40 you make money. I mean, at $40 you're breaking even. You're not making money, but you're breaking even. So
Yeah, and that's I'm glad you brought that up, because yeah, there are different definitions that everyone uses. I think sometimes people are just trying to be cute and confuse the numbers. Sometimes I think it's just honest accounting. Accounting can get very confusing, and everybody has to do it differently because of the exchanges they're on, because of the jurisdictions they're in. Just there are a variety of reasons. But when I say all in, we're in the 40s, I mean all in. I'm not excluding anything. That includes royalties, ad valorem tax, severance tax, executive salaries, the electricity in the corporate office. It is everything. I'm not excluding anything. And that low cost, it allows us to get into production at a lower price level, standing a nice profit margin on those contracts. So that's a benefit we enjoy that, frankly, a lot of our competitors don't.
yeah, that's it's the question that I ask. Is it just like, okay, don't tell me any fancy accounting terms or whatever. Just tell me, when do you break even? When do you keep, how do you keep the lights on at, is it 30, 40 or whatever? And a lot of times these prices go up, because you said cash cost at 16. And so you can easily put that on your presentation and sort of lure people in thinking, oh, this is a very low cost producer. But it's almost impossible to, I mean, cash cost doesn't really represent all too much.
No, it doesn't. There are two numbers I think people should look at. Number one is my all-in mine site cost, and the other is the complete cost, which includes all corporate overhead, includes everything. Those are the two numbers that people really should look at.
Good point. Good point. John, I don't see those fish behind you. You used to have fish behind you. What
Yeah,
happened to them?
I've got them over to my right.
Can we ask them where the uranium price is headed? I thought those were fish that swam in uranium water or something. So I wanted to ask them where the price is going.
I don't want to say there's a consensus, but there's a very strong thought right now across the spectrum. Fuel buyers, utilities, traders, miners, that the price is going to continue to increase fairly significantly over the next few years. Supply is not meeting demand, and I think there are going to be some challenges for supply to meet demand. Then you throw the geopolitics on top of that, and it looks like the prices are heading higher. How much? It's hard to say. We are not so much in the speculative crowd that believes that the long-term price is going to be $150 and it's going to stay there forever. We don't believe that for a second. Do we believe that the long-term price could spike for a while into $70, $80, $85 terrain? That's quite possible, but that will bring a lot of supply out of the woodwork and tend to drive the price back down. So in the long term, I think, just looking in today's dollars, I think it's reasonable to expect 65 to 70. But we'll see what happens. It's so hard to predict. And then again, you throw the layer in the geopolitics on top of that, and what happens with Russia in the long term with that supply. How quickly is that relationship mended after the war is over? Whenever that happens, hopefully sooner than later. Those things are so hard to predict. But again, we have the benefit of being such a low cost producer that even today, at today's prices, we can make money. And the contracts that we have signed, we've not disclosed anything on an individual basis on the pricing on those, but we're getting a producer. The utilities are coming to us now and saying, hey, look, we really need to diversify our supply chain. We need to move away from the east toward the west. And so we're willing to pay more for those contracts. And so the contracts we've got in place right now, they're not at the spot price. They're not even at the long-term price. We have a multi-dollar premium on top of those in recognition of the supply that we provide from a safe jurisdiction.
I am going to move on to in a minute to talk about more specifically some of these things that you brought up about URG. But I want to tap into some of your knowledge around the other topics that you brought up. But first of all, why not 100? Like, well, why don't you think that the long-term price could surpass, triple digits this time? What makes you think that it's not?
Yeah. I think it could in the short term, but then I think there are so many projects globally that, at $100, $120 a pound that'll come into production that'll swamp the market. There's always a balance between supply and demand. And as that price goes up for the commodity, it brings in more supply. It's just supply demand fundamentals, no matter what commodity you work in. And I think there are so many pounds of uranium out there that are available at that price that'll just swamp the market. So I think that could happen. If some excitement gets put into the market, there's already black swan events, major mine floods, or supply gets cut off geopolitically through sanctions. Those black swan events can cause significant spikes, especially in the spot. But I would expect that over time, and by time, I mean 1 or 2 years, 3 years at the most, we would start to see supply come back in that would bring that back down. Now, there is a real lack of supply that can be brought into the market at 50 to 60. And so I think we'll stay north of that going forward. Simply my prediction, my crystal ball, if you will. But do we stay north of 100 in the long term? No, I don't think so. I think 65, 70 is probably a much more realistic number. And certainly at those prices, with our low cost, we're cutting a really nice profit.
All right. So it's your crystal ball. It's your talking uranium fish that tell you that. It's good that you're mentioning it. But it's what I've been thinking is like, okay, what if utilities have to contract at exact that time period where supply, sure, the price, let's say the financial players spike up the spot price a little bit more. Utilities have to contract. So some of these contracts reference the spot price to a certain extent. And sure, that gives a signal to start production. But I mean, what is it going to take you? If it gives you a signal to start production for you specifically, but also for other people, like at Shirley Basin, you said it's going to take you 18 months, a year and a half. Some other companies might take them longer. We're seeing, pipes and acid supply issues. So in that period, if utilities have to sign contracts, could it or could it not be that they're going to be signing, in the very high double digits or even low triple digits, at least some of them?
Yeah, no, I think that's possible. And, an interesting issue there is it takes a while to get ramped up. And I'm glad you've mentioned that, because the companies that are already producing and are already ramped up, that have the manpower, that have expended the capital and built out, have the permits in hand, those are the companies that are going to be ready to enjoy those very high priced contracts if that happens. And again, we're in a very small club. We check all of those boxes. We're ramping up right now. We'll be ramped up within a few months, not years, within a few months. In fact, we'll be turning on significant flow in the plant within a few weeks here. So it's companies that have positioned themselves in that way that will be able to benefit from those much higher priced contracts because they are ready. They can flip the switch and turn on. Companies that just talk, they don't have the employees. They may be lacking permits. They may be lacking a little bit of land. They are lacking pipe. They're lacking contracts to buy supplies. That's going to take them much longer to get ramped up than what they expect. And so, yeah, there could be a bit of a price run up for a while because of that lag in the supply. And we stand ready to benefit from that.
I get it. What you're saying basically is that the price could go higher for a certain period of time, but it's not prudent to build a business around the assumption that the price is going to stay there for the next 15 years. That's sort of
That's exactly right. That's exactly right. I mean, take a look at the history of the price in the uranium industry. There have been some awesome spikes. The companies that have been ready to benefit from those spikes have done incredibly well during those time periods. And I believe we've positioned ourselves to do that. We've been careful not to contract in too much right now. We still have a lot of capacity that's uncontracted at Lost Creek, and we're completely uncontracted at Shirley. And so we can ramp up very quickly at Lost Creek, especially since we have our employees hired now. Shirley Basin, like you said, probably around 18 months. But we can do it fairly quickly and respond to that market.
Mm. What do you think matters the most for the uranium market right now? Because you said in response to that market, in terms of all the developments, everything that we have going on, nuclear renaissance, Russia war, all these things, what matters the most right now?
So I think from a basic supply demand fundamental, that story evolves in our favor, but it evolves over time. We don't build nuclear power plants overnight, so that new demand is not coming back online or online very quickly. So I think we have an incredibly bright future in the mid to long term based on just supply demand fundamentals, and even in the short term. But I think the real potential for a black swan that could really drive the market is geopolitics, especially what happens with Russian supply. And then does that trickle down into any of the Soviet satellites, former Soviet satellites? I think in the very, very near term, i.e. weeks, maybe months, that's what we're most interested in watching, what happens there. But I think that's the market driver in the near, medium, and long term. First is geopolitics, but beyond that, tremendous growth in our industry. So many countries around the world are building out reactors right now. We just had one come online in the U.S., and another one will be coming online late this year. There's talk about keeping Diablo Canyon up and running. There's talk about bringing Palisades back online. And in addition to that, the other 93 reactors that are up and running, they were slated to be turned off over the next 10, 20 years. But now with the Inflation Reduction Act, it looks like all of those, or nearly all of those, will stay online. So there was an expectation that that demand from them was going to go away, but now that's reversed. And we're seeing a similar story around the world, including new builds. So yeah, demand is growing, and I think it's going to increase.
How has, in this type of environment, how has it been to, dealing with utilities right now? Like you said, they're calling, they're calling you. You don't have to chase them. But how's their, this might sound superficial, but how's sort of their tone of voice? Like, are they panicky? Like, are they worried about what's happening at all?
I think they're worried. Are they panicking? Absolutely not. This is a very well considered, intelligent group of people. They know what they're doing. But are they concerned about the future of supply? Oh yeah, and they acknowledge that. And again, they're watching the geopolitics. What happens there? How's that going to impact supply going forward? But right now, they're reaching out to U.S. producers, Western producers, looking to diversify their supply. So they are initially, after the invasion of Ukraine, it really was clear that the world was very short on conversion and enrichment. So I think for a number of months after the invasion, they were trying to lock up that conversion and enrichment supply. Now that I think that's kind of coming to an end, they are now moving toward the fundamental supply of yellowcake, the feedstock, to go into that process. So it has taken some time for them to get to the front end of the fuel cycle, but they're there now. And so they're out fairly aggressively looking for safe pounds and diversification.
I know that you and your company, I mean, specifically your mentor and your predecessor, Jeff Klendo, I've spoken to as well. You're very well aware of what's happening in space in terms of politics. He's also very well connected in terms of politics and how those things actually work. And I can only read what the media says, which is frankly most of the time not really enough. So what I'm talking about here is I want you to talk to me about the famed ban on Russian uranium. There've been countless bills passed here and there. What's really like? Will it happen? Can it happen? Could it happen? When would it happen if it did? Stuff like that. Talk to me about it.
Yeah. So right now there is our bills pending in the Senate and the House in the U.S. Congress. I've been pretty open about this for many months. I was a bit agnostic on whether anything could happen there. Certainly there was pushback, lobbying in opposition to cutting off of that supply. But I think over time, entities have reversed course on that. And they've said the war has drug on too long, too many atrocities. We cannot have a straight face and talk about ESG sustainability if we continue to buy material from Russia. So I think slowly with time, everyone across the fuel cycle has come to the conclusion that, yeah, we've got to move away from Russian supply. And so for, like I said, for a long time, I was agnostic on whether anything could happen. But I think the bills that are pending right now have a relatively good chance of passage. And it's only been a few weeks I've been saying that now, because it seems like the lobbying opposition against that has dissolved, and everyone is acknowledging we've got to move away. So yeah, if I were placing a bet today, I would say there's I'll say a 65-70% chance those bills are going to pass. They'll probably be redrafted numerous times before passage. And but right now it looks like it calls for an immediate cutoff, but it does have a provision that would allow utilities to seek waivers to get material from Russia if they can't get a Western supplier. So there is a pressure relief valve there, but that's how they're drafted today. That doesn't mean that's how they'll pass, or even if they'll pass. So yeah, but I'm, in a nutshell, I'm more optimistic today than I have been in a long time that supply chain will get cut off. I wanted to say that probably is a little bit overhyped. It's important. It's very important, but I think it may be a little bit overhyped with regard to the price of yellow cake. If that bill passes, do I expect the price of yellow cake, even on the spot price, to go north of $100 a pound overnight? No, I don't. I don't think that's realistic. Could we see a few dollars a pound overnight? Maybe. But I think the second part of that is what we really have to watch is there a contagion there? Does that affect other countries? What is Russia's response to that? Do they try to influence Kazakhstan, Uzbekistan, former Soviet satellite states? And if so, are they successful there at preventing the flow of that material coming to the West? If that happens, that is a big deal. And could we see a $100 handle on the price of uranium overnight? If that happens, yeah, you could. It's all speculation. Speculation. We'll see how it turns out. But we watch the news very carefully. We're members of the Uranium Producers of America. They keep their ear to the ground very closely, and we participate in all the meetings and listen in to what's going on. So, yeah, we're waiting. We have to be patient. These things don't happen overnight.
Sure, Dan. Sure, Dan. What else do you think is overhyped? There's so many things that are overhyped when it comes down to this thesis. Even though it could have been a simple thesis that still works. Do you think that financial players are also a little bit overhyped when it comes down to their effect on the long-term contracting market through affecting the spot market?
Perhaps. I mean, we have to recognize that the spot market only represents 15, maybe 20% of the total market. And so while that's the number that moves and it's the number people tend to watch, it only represents a relatively small percentage of the overall market. Most of the utilities really play in the long-term market. And certainly as a producer, we play in the long-term market because we like the stability that long-term contracts provide our company. So, yeah, I think keeping too close of an eye on the spot, I mean, it's entertaining and it's fun to do. And I'll admit I watch it every day. We subscribe to several services that provide those numbers, and I watch them every day. But really, it's the long-term price that is of most impact and of interest to the miners and to the utilities.
Okay. But so in the end, right now, main thing that you're watching, I suppose, is replacement rate contracting. Do we get there, and what influence does that have on the market, right?
Yeah, exactly. And, I've been a bit of a wet blanket here in the conversation. I don't mean to be. I think the prices of uranium are going to go higher. And we stand to benefit fairly dramatically from that. But I don't buy into the hype of the $100 plus in the long term. Do I buy into the 65, 70, maybe 75 long term? Yeah, I think that is certainly in view and quite plausible, and would have a minimal impact to the profitability of utilities. And but there are a handful of miners, a small handful of miners that are going to have some incredibly nice profit margins in that range.
You say that you stand to benefit from that $65, $75 range because of that low cost that we spoke about. So I want to talk about that and see what risks might be around that claim of you being a low cost producer. What I mean by that is, like, for example, you've recently been hiring people, right? Have you found yourself having to offer a lot more money than what you expected, or a lot more benefits, or like is it costing you more than what you would have expected?
Yeah. So, it has been interesting as we've gone through ramp up. And again, we're getting to the end of that right now. Hiring, my goodness, has been challenging. I'm not going to lie about it. It took us months to hire the staff we have. I think we still need about 3 positions, but we're there. Are we paying a little more? A little more, not dramatically more. But it's important to know that those numbers are essentially now baked into the cake. Those numbers, those costs are not going to go away. We can't go to wouldn't go to our employees and say, hey, the market's not in your favor now. We're taking $3 an hour back. We're not going to do that. So those costs are real and they're baked in. Mm-hmm. There are other things that we're seeing fluctuations in pricing of piping, for example. PVC, the price continues to go up, and it doesn't seem to have necessarily peaked yet. But HDPE, high density polyethylene, those prices have peaked and are now coming down. So on those supplies like that, piping, chemicals, cement, those prices come up and down, they fluctuate. So they're not necessarily baked into the cake, but certainly manpower costs are. The other challenge that we faced, and again, this problem seems to be being resolved right now, is drill rigs. There is a real paucity of drill rigs right now. They've moved to the water well industry. There are a lot of people moving from population centers into Wyoming and other less populated states post-COVID. They're trying to get out of the madness of the big cities, get back to a quieter life. And so they all need a water well. And those people that are moving in, they're willing to pay a premium for those services. So a lot of the drilling companies now have moved into the water well industry, but that also seems to be resolving itself. A lot of those drilling companies are moving back into the minerals industry. And so that seems to be resolved. But for a while, we struggled with that. But chemicals, seems like we're doing okay on that. Electrical equipment, monitoring equipment, it seems like we're doing okay on that. But I would say that it takes a lot more forethought than it did 3 years ago. For example, if you need a transformer and you need a transformer, you probably should have ordered it 12 months ago, maybe even 18 months ago. So you have to be thinking much, much further ahead with today's supply chain issues. But those are some of the challenges we face. Some of the costs are baked in and some are not. Some will continue to fluctuate.
So it's a good spot 3 years ago that Mr. Klendel left you in. Like, he sort of left you in the spot, and then everything started getting more challenging. So, and that's how you really learn, I guess. And you've been doing a good job too. So, well, what are some other challenges? What are some challenges that I might not, as a desk researcher, what's something that I might not be seeing?
Oh, you always have to watch the permitting front. You mentioned earlier that we're working on permitting. So for clarity, Lost Creek is permitted. We've got multiple years of production that's 100% permitted, ready to go. But as we expand to the east, in particular, LC East, we're working on permitting that. I would say right now we're 95% of the way through permitting, maybe 98% of the way through permitting there, but we're not done. And until you're done, you're not done. So there's always risk associated with that. But we're very close there. We have very strong allies, neighbors that are very strongly supportive of us, and we work in a fantastic, well-defined regulatory jurisdiction. So we're glad about that. But watching permitting, then on the regulatory front too, there are some rulemakings right now that are ongoing that will probably take years. They're not going to happen in months, probably years. One is with the Department of Interior with regard to how they manage public lands. We're keeping a very close eye on that. So there's a draft rule out on that. And then the Nuclear Regulatory Commission also is doing an in-situ rulemaking that will have a direct impact on us. That rulemaking has been going on literally for years. And we don't know how or when or if that's going to continue. But that's, we're keeping an eye on those things. Those are very important to us. They can have very positive impacts, especially the in situ rule. I actually look forward to the evolution of that rule. I think it could have a tremendous benefit to our industry. But we have to keep an eye on those things, and we do. We have people that watch those religiously, so we know what's going on.
You're mentioning that you're licensed 100% for the next couple of years, and your total license capacity, as I mentioned at the beginning, at Lost Creek is 2.2 million pounds, right? But that's not where you're at right now in terms of production. What is the plan to get to the next milestone and then go further to that full production? So talk to me about how you get to 1 million pounds per year production, and then how do you go to that full license capacity?
So just very quickly, we have two different numbers to talk about on licensed capacity. The mine itself at Lost Creek, it's licensed, and we have complete approvals for 1.2 million pounds per year from the mine. The mill that's attached to it, we're licensed at 2.2 million pounds per year. The delta between the two, it allows us to bring in material from a competitor or from one of our other facilities for toll processing. We're going to continue to work on contracting. We're very happy with the contracts we have in place right now. They're very high priced. We're going to continue to look to sign contracts, but only high priced contracts that are profitable as they become available. And then our production rate, we will ramp up into those contracts. So for this year, the remaining contract book is at 200,000 pounds, plus or minus a small flex. So that's our goal this year, is to produce right around 200,000 pounds this year. Next year, and for several years thereafter, that contract book goes up to 600,000 pounds. So our goal is to ramp up to that 600,000 pounds per year. And then as we layer in additional high-priced contracts, we'll continue to ramp up into that. Now, as we get going, we might overproduce just a little bit, give ourselves a little bit of buffer. We run very conservatively, but also be able to respond to any spikes in the spot market if we have an opportunity there. But that's our objective, really, is to produce into contracts. So we're not going to dramatically overproduce. As we contract out the capacity at Lost Creek, then we will look to begin contracting out the capacity at Shirley Basin. Once we reach a state of contracting at Shirley that justifies building it out, that's when we'll pull the trigger and build out Shirley Basin. So we're not going to put capital in the ground ahead of it. Everything is really predicated on contracts and what that allows us to do.
If you had to guess, how long before you can be at that full production with the market developments and everything? I understand there's too many moving particles maybe to make a too well of an educated guess, but if you just had to guess, how long?
Let's assume that everything goes our way and that within a few weeks here, we sign up all the contracts we want at the pricing we want. So this year, production 200,000 pounds. I don't think that changes dramatically no matter what. We're already in second quarter, so we'll say 200,000 pounds this year. But if we get our way, then next year we could fairly easily ramp up to 800,000 to 1 million pounds per year. And then after that, the third year, 1.2 million would be very obtainable. And then for Shirley, assuming that contracts come in within a few weeks, let's assume 18 months to build out and ramp up. That 18-month is not just a build out. We can build out in probably 6 to 8 months because it'll only be a satellite facility. So the build out on that is very fast. And for example, Lost Creek, when we built it, the full plant, not the satellite portion, but the full plant, we built it out from start to finish in 9 months. So when we get to Shirley Basin, probably 6 to 8 months from a go decision, we could build it out. But then you need multiple months to ramp it up. So we'll say 18 months all in from a go decision to the time we're at commercial production levels. And probably the first year there, first 365 days, not calendar year, but first 365 days, you could probably look at 300,000-ish pounds. And then the next year, 800,000, and the next year, 1 million, getting it up to full capacity. And earlier you did mention, an agreement with a smaller junior, and we have signed an agreement with Strathmore Plus to take a look at utilizing some of our spare capacity to process their material and to do other work with them. And so just would comment there, we'll be careful not to use up our production capacity for anyone else. We've got a lot of opportunity to expand that capacity. The licensing and the permitting on that is relatively simple because the footprint is already there. The environmental impact has already been assessed. So putting in 2 or 3 more tanks, that's easy. And so we'll be careful to not interfere with our capacity. But in the meantime, we're glad to work with others. Having a licensed constructed facility offers a lot of benefits to some of the other companies that have really nice little projects in the area, but maybe they're not big enough. Maybe they are, but maybe they're not big enough now to justify a full build out of a facility. And so we're glad to work with them to utilize our facility to give them a hand, and we'll make some money from that as well.
So it's in ideal conditions, it's a 3 to 5 year plan where you see yourself ramping up to I mean, give or take. That's how I translate it. What happens after?
I think 3 years, if everything is right. In 3 years, we could maximize production at both of those facilities.
Okay. What happens after that? Like, do you want to turn this into a dividend-paying company, or do you want to grow the valley through more exploration, through M&A? Do you maybe have a different growth pipeline? What happens after that?
So we are looking at a couple of things. Exploration. We've not talked a lot about exploration with our company because we've got so many resources in the ground. Our mine lives are fairly long. And so we just have not talked about that much. But at Lost Creek in particular, there is so much ground out there that we control that we know has redox fronts on it with mineralization. And so we're going to start talking about that more. I think we've done a poor job of that. And so we'll talk about that more. Tremendous opportunity to grow the resource. We've done 6 exploration programs through the history of the company at Lost Creek. Every one of them has been successful at finding more pounds that we've brought into NI 43-101 compliant resources. We've done technical reports on that. And we believe that, a forward-looking statement here, but we believe we can continue to do that. So far, our average exploration discovery cost is 50 cents a pound. So when I look at M&A versus exploration, I have to consider, okay, I'm finding it for 50 cents a pound at Lost Creek. Do I keep exploring there and finding it 50 cents a pound, assuming I can, or do I apply the capital to M&A? And there are other things to consider there, jurisdictional diversification and things like that we have to look at. But that's one of the metrics we're looking at to grow the company. We've got a lot of potential for exploration, but when do we move over into M&A? And certainly we're looking at opportunities in M&A. There are only very limited opportunities in M&A. Let me rephrase that. There are only very limited good opportunities in M&A. There are tremendous opportunities. Most of them are not worth pursuing. We are a mining company. Anything that we acquire, we want to make sure that it's something we believe we can bring into production at a reasonable cost in a reasonable time frame. We're not looking at acquiring projects that are going to require $100 a pound in the market. That's not us. We want something that we believe we can bring in at an all-in mine site cost in the 30s or maybe low 40s. That's what we're after. So we're only looking for quality assets. We have to be patient. We have been patient, but when it comes time to be aggressive, we will be aggressive. And we know the difference. We've got experienced engineers, miners, geologists. We know the difference between junk and quality projects. So we're watching that very carefully.
What I'm trying to understand here is how do I monetize that as a shareholder? Because I mean, you're clearly not out there looking to get acquired yourself. I assume it's nothing's off the table, right? The right amount of money comes through, you have to consider it, sure. But that's not the main thing, like it is with explorers, right? Explorers are hoping to find something, sell it, monetize through that way. So how do I monetize that? Where's the growth potential for me as a shareholder, I guess is what I'm trying to ask.
Yeah. So a few things on that. First off, we will try to always do our best to do what's right for the shareholders. So if anyone walks through the door with a big bag of money, and makes a serious offer, we are required and we will seriously look at that and try to make the recommendation that's best for the shareholders. So I think that's pretty clear that that's what we'll do. But that's not what we're pursuing. We want to grow the company organically, but also through M&A. So when you look at the valuation of the company and how you benefit from that, share price certainly is one way. We're doing our best to bring in quality assets and have good quality news flow that's meaningful. We don't come out with a press release every week saying that we drilled a good hole. That's normal. We drill good holes every week. And so we're not going to press release that. We come out with meaningful news from time to time. So we're going to try to continue to get that good news flow, continue to look for a good acquisition. You mentioned dividends and things like that. They're not on the table right now. But as we move into good revenues and we develop our portfolio of production, maybe it can be. But it's something that's not on the table. It's not a serious discussion right now. We're still too early stage to really seriously consider that.
When it comes down to working with some of your neighbors, potentially for them putting ore through your mill, basically, how does that work? Like, how do you make money on it? How does that get calculated? Do you get a percentage of their earnings? How do you make money on that?
We're only limited by our imaginations when it comes to those types of contracts, but very commonly it's done on a per dollars per pound basis, typically several dollars per pound for everything that they would run through our mill facility. And so that's what we'll look at most likely is $1 per pound. But there are other things that can be done too. It could be done for shares. It can be done. Who knows? The door is wide open for the consideration on that.
Okay. And when it comes down to M&A, you said something about geographical diversification. There's not many. I mean, there's not many interesting things, as you mentioned, for that maybe fit your profile. Would you want to have geographical diversification necessarily for the sake of having it? And would it also mean that you still want to stay within ISR production specifically?
Yeah, no, two very good questions. I'll start with the latter and work to the former. So we are in-situ miners. That would be our strong preference going forward, is to stick with in-situ. My geologists, engineers, miners, they've all put millions of pounds in the can using the in-situ technique. So for us to move to something conventional, I'll never say never, but that's pretty unlikely. It would have to be a special asset. And if it is a special asset, then we would consider it. But going to jurisdiction, our strong preference would be Wyoming. We love Wyoming. But there is a strong case to be made that you shouldn't work in just one state or one country because things happen. I can give you an example. You asked me about what keeps me awake at night. There are pieces of rulemaking that are making their way through the process through the Department of Interior. We don't expect anything severely negative to come out of those, but it could. And we work largely on federal land at Lost Creek. And so if a rulemaking would inhibit our ability to work at Lost Creek, that could be very problematic for us. Sure, a Shirley Basin is mostly on our own private land, so that helps us in that regard. But some jurisdictional diversification is always advisable and a good thing. And so, yeah, we would look to work in other jurisdictions. We love Wyoming. It's a great place to be. In fact, I'm going to say it's the best state for uranium mining. But we would consider other states. We would consider other countries, but that's going to be very limited. We would look at Canada, Australia, maybe a few European nations that are pro-nuclear, pro-uranium. That's a really short list. Yeah. And then you combine that with my in-situ limitation. It's an even shorter list. So yeah, we would look at other states for sure. We would look at other nations, but it's a short list. It has to have a good mining jurisdiction, and if not, we're not interested.
Absolutely. Why I'm bringing that up specifically is because I really wanted to talk about your cash position. As I mentioned, roughly $80 million at the beginning of March. We're now almost 2 months later. There's probably a little bit less in there. Still a significant amount of money that you have on there. What are you going to do with it, basically, is what I'm trying to ask you.
Yeah, absolutely. So we were not low on cash when we went out and did the raise in February. I think we surprised some people that we did a raise. But the best time to raise money is when you have money. If you get down to a few $1,000,000, the bankers know that. We're a publicly traded company. We're an open book on the financials. And so the bankers will really stick it to you on the rates. And so we wanted to avoid that. Going through ramp up, the burn is pretty high right now. We're going from essentially being flat footed to a sprint. It takes a lot of energy, a lot of money to be able to do that. We're doing it successfully, but it does take a lot. So while we were not thinking we were going to run out of money, we knew we were going to get low, and we felt we didn't want to have that insecurity going into ramp up. We don't expect technical problems, but it is mining and there can be technical problems. So we wanted to make sure we were covered. Beyond that, we saw the broader market softening, and we felt, if we're going to pull the trigger on a financing, now is the time to do it. And frankly, I'm glad I did, because the market softened just a couple of weeks after that. And I'm really glad we raised at $1.18 and not at 90 cents. The entire sector has really been in decline. I can't explain that. Maybe it's part of a broader commodities issue. I'll be interested to hear your thoughts on that, Antonio, but I'm really glad we raised at $1.18. Our share price, we're hanging in there with our competitors. In fact, most of our competitors, we are outperforming on a share basis. So we're happy about that. But the other primary reason, let me get back to that, for the raise was for M&A. We do want to consider other opportunities. And if you don't have any money in the bank that you can dedicate to M&A, then it's really hard to have a seat at the table, at least to have a serious discussion. So that raise put us in a position for a number of assets that we can have a serious seat at the table. So those are really the two primary reasons why we did the raise.
Why I'm asking that is because it's important, I guess, for me to see that you have a plan for that money. Because if you have money that you don't necessarily need or specifically know what you're going to do with right now, you could be overspending on some other stuff, thinking, oh, I got plenty of money, like, I can do this, I can do that. So that's why I'm asking about you having a plan for that money. So.
Yeah, no, capital is precious, and my team knows that. We're very tight-fisted. I don't fly first class. I fly coach class with everybody else. I'm happy when I get upgraded and I don't have to pay for it, but I don't buy first class tickets. We're very careful with the cash. We have to be respectful of the shareholders. It's their money. They're our bosses. We're trying to make a return for them. So it's our job to be careful with that money.
All right. I think I'm all out of questions, sir. What am I forgetting to ask here? What did you want to talk about when you came here today?
Hey, I'd be interested to hear your thoughts on the broader market, Antonio, where you think it's going to go. I know you talk with a lot of people in the uranium space, and so love to hear where you think the market's going to go I'll break it up in the near term, but also the medium term. So maybe near term is over the next year, medium term over the next 5 years. What do you think is going to be happening in the market?
I want to caution you not to overestimate my abilities, because the reason why I'm talking to these people is because I don't know what's going to happen. Nobody does, but I don't even have a clear guess. I can tell you what some of them have been telling me, though. Most are saying, when it comes down to interest rates higher for longer, meaning still tighter liquidity, at least for the rest of 2023. People are saying, the Fed too is saying, mild recession in 2023 and then recovery in 2024, 2025. So does it take, the biggest question that I've been trying to answer for myself is, does it take liquidity coming back into the markets so that we can see increased interest in the uranium equities, and uranium in general means spot's been trading at a double-digit discount for a while now, which just tells you that sentiment and interest for this sector is gone. It's not here right now. And does it take that for it to come back, or does it take some type of another event like what we talked about today? The financial players drying the new Swiss fund drying up the spot market, or does it take a Russian uranium ban or something like that to sort of kick this up into a higher gear and get more interest back into uranium, or does it take liquidity coming back into the markets? And if the answer is it take liquidity to come back into the markets, and the Fed is saying mild recession as well as higher for longer, that might mean that we still have a couple of months at least ahead of us before we can start going back into positive territory. But if uranium was to decouple because of some type of a positive black swan event, I mean, then all bets are off. But that type, that's the thing about black swan events. You cannot really see them coming up. So I know this is vague, but this is more or less what people have been telling me. So
yeah, no, I think you're spot on. And I think one of the things about our company, and it kind of correlates with what you're saying there, is no matter what happens, we're in a good position. We have a tremendous cash balance right now, very limited debt, very good long-term contracts that are going to see us through for years. And so if the market gets hot, we're ready for it. We've got our people, we're ramping up, we're ready to sell into more contracts. So we're ready for that. If the market stays flat or is negative, we're ready for that because we've got those long-term contracts. So I think we've done a good job of insulating the company, and we're prepared for whatever happens. So I think that's really what we're well known for, is just being ready for anything.
That's a good place to leave it at and sort of pick it from here next time we speak. Thank you so much for investing your time in me, and thanks for being here.
Yeah, thank you, Antonio.